Namaskar, this is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. After the Indian economy was ravaged, shaken up and contracted because of the second COVID wave, it has now been opening up, it has now been recovering. While the possibility of a third COVID wave remains, its fear does not, because governments this time are better prepared and far more confident of handling a COVID resurge, even if it be of a Delta variant. The intermittent lockdowns and lingering uncertainty since last March had fatigued the Indian economy and had depleted jobs, it had depleted household savings, and thus an eager labor force is now returning to work, because of which demand has been resuming. It is actually too early to predict demand trends over the coming quarters, since what is surfacing now, in our opinion, is the pent-up demand and the festival demand, both of which are transitory and temporary. Of late, to us, two clear patterns of growth have been analyzed in the Indian economy, one of which is visible and the other not as yet visible. The visible pattern in the Indian economy is that of a short-term growth because of the pent-up demand and because of festival spending, which tend to fizzle out after the season is over. Such growth lacks inherent momentum on its own, such as to roll into another quarter and in another quarter and trigger an economic growth cycle. The other pattern, which is yet to make an appearance, is that of long-term growth founded on sustainable demand. A nation like India, with a population of 1.4 billion, is bound to resume spending after a lockdown is lifted. But without the support of jobs and without the support of increasing income, it truly does not sustain. It gets exhausted almost as soon as it begins, as we saw last year. India has not really seen consistent quarter after quarter growth since 2017. Yet, once growth picks up, optimism returns, and that has been the story of the Indian economy in September 2021 also. To us, a number of dots or reports have been appearing, mostly tinged with optimism, and it is time thus to connect the dots and see what is the emerging picture in the Indian economy and whether there is an emerging picture at all. The first report that we talk about is that of the spurt in direct tax collections, which tell of a recovery in the Indian economy. India's net direct tax collections of rupees 5.7 lakh crores till 22nd September 2021 show a 75% jump in tax collections as compared to the same period, not last year, but as compared to the same period in 2019. The direct tax collections have increased across all sectors except telecom and aviation, which shows to us a pickup in growth and a recovery perhaps in the offing. While the improved tax collections are also because of increasing digitization and formalization of the Indian economy, it yet cannot be denied that a growth in demand in the second quarter of this year has been at play. A Mint report supports this fact by saying that of the 16 macroeconomic indicators tracked by it, 8 are in the green, which is they are above their 5-year average, and at the moment they are at their 2.5-year best. Other high-frequency indicators have improved, and an improved manufacturing PMI for August supports the Mint analysis. So does the August exports crossing $30 billion for the 5th consecutive month. Yet another report on the Indian economy comes from the global rating agency Standard & Poor. S&P says that there are indications of a strong rebound in the economic activity in India after the second COVID wave. While the economy contracted during the April-June quarter, the high-frequency indicators now suggest a strong rebound in the July-September 2021 quarter according to Standard & Poor. It, however, sounds a note of caution on many fronts, showing that the recovery could be fleeting and thus it is not really predicting a long-term trend. S&P's caution notes say that the MSME sector was the worst affected one by the COVID and it will slow down economic recovery since this sector, in the opinion of S&P, will seek to strengthen its finances first and only then pursue growth. The second note of caution, according to it, is that inflation remains relatively high and it can be a dampener to growth. It then says that due to the possibility of emerging COVID variants and a slowdown in vaccinations, there will be a need for stricter virus control measures, which can again hit consumption because the primary virus control measure is always a lockdown. It finally cautions that in the matter of discretionary spending, which tends to substantially boost economic growth, India will not return to its pre-COVID levels till 2023. In other words, households facing depleted wealth will choose to save rather than spend, and that will impact growth. That explains why, even though S&P reports a sharp rebound in economic activity in India, it has yet not changed its growth forecast of 9.5% of the Indian economy for the current financial year. A report from the CMIE echoes these notes of apprehensions that have come from S&P. CMIE says that India's recovery from the lockdowns of COVID-19 has been swift, partial, but exhausted and discriminating. It points out that even 17 months after the draconian lockdown of April 20, employment continues to be lower than what it was in 2019-20. At 397.8 million jobs, employment in August 2021 was still 5.7 million lower than what it was in 2019-20, according to the CMIE. It says that the recovery seems exhausted because the incremental growth improvements have been diminished drastically. Job losses are concentrated amongst these salaried employees, and thus the recovery seems to have discriminated against entrepreneurs and the salaried employees. The CMIE findings, we believe, reflect the prevailing ground reality in the economy as we also see it. Yet another opinion on the state of the economy comes from Sanjeev Sanyal, the principal economic advisor to the Ministry of Finance. He expectedly says that India will record a double-digit growth in the current financial year and also in the next financial year, provided that there are no more COVID disruptions in the country. He says that demand is now recovering pan-India. According to him, there is enough fiscal space available with the government to pump resources in the economy and support growth, and so is the case with monetary policy, according to him. Mr. Sanyal says that the government will focus on infrastructure creation through increased capital expenditure and that it will continue to ramp up its capital expenditure for such asset creation. Our reading of the present state of the economy and that in the near term is something as follows. We think that the present upsurge in demand is primarily due to the post-lockdown pent-up demand. It is because of the festival season demand and also because of a certain amount of revenge shopping by fatigued households tired of being homebound. This demand, as we see it, will fizzle out after December 2021 because of the prevailing loss of jobs, prevailing loss of livelihood, income and confidence. It will not fizzle out in case there are government measures coming in because of which the economic cycle catches steam. No long-term trends therefore should be read in the present economic rebound. The other issue that we see is that after the pent-up demand, festival demand is over, continuity in consumer spending will happen only if consumers' confidence returns, which today is at an all-time low according to the Reserve Bank surveys. To us, the real long-term durable growth will be visible only if investments in fresh capacity build-up take off in India, and so do bank loans and so do new jobs. Those are the real indicators of growth to look out for, and they are all missing at the moment. The next is that inflation and a rise in global commodity prices, as also the withdrawal of global liquidity, are factors that can topple the expected apple cart of India's growth. While the Chinese economy has been slowing down and it is in chaos because of the Evergrande and because of its power crisis, there is thus a potential for India's growth in exports to take off and meet global demand in the process. Recovery in the MSME sector is crucial to us And if that does not happen, then durable overall economic growth will take time to kick in. And finally, the Reserve Bank's monetary policy will continue to support and err on the side of growth and not on the side of inflation control. Do not expect any further fiscal support from the government, not that it was really there in the past. This, we think, is the present reading of the Indian economy. And the pattern that we see in the rebound and in the recovery is that it is little because of government policy and support, and it is largely because of the interplay of market forces, despite all the government blocks to growth which are there all the time. Recovery would have been much better. Recovery would have been far at a faster pace had a genuine and timely support by way of a fiscal stimulus come from the government. That did not come. Thus, the recovery is being purely guided by market forces. And if the government wants to take credit for the present surge in demand and recovery that we are seeing, then that credit is truly not due. This is Akhilesh Bhargava signing off till we meet again. Namaskar.